right, hello and welcome to Investing Concerns in a Fragile Market. Thank you for joining us. You should see on your screen the PowerPoint presentation for tonight. If you don't see it, please let me know. Or if you have any issues hearing us in the room, please let me know. I will be monitoring the chat. My name is Megan. I'm the Adult Services Librarian here at EOLA, for those of you who don't know me. So if you have any questions at any point along the way, don't be afraid to drop them in the chat. I will see them. And we do have a speaker here in the room, so if you would like to speak, that is also a possibility. Tonight's presenter is going to be Greg Kurinec with the Society for Financial Awareness. Greg, did you want to introduce yourself?
Sure. Thank you, Megan. Thank you, everybody, for attending. For all the mothers, I hope everybody had a wonderful Mother's Day yesterday, and it was a beautiful day, so I hope you were able to enjoy it. But my name is Greg Kurinec, and I'm with the Society for Financial Awareness. And what SOFA is a 501c3 whose mission it is to spread financial literacy amongst the community and empower those in the community when it comes to their financial planning and their financial needs. So we get invited to different groups, organizations, places of worship, places of employment, things like that to provide educational workshops on different topics of financial education. And my specialty happens to be retirement planning. So I work exclusively with people at or near retirement. I help them with their investment advising, risk management, estate planning, tax planning needs. So I'm a comprehensive financial planner. I am a certified financial planner, CFP. So I've been doing this for a little over 18 years now. I'm a graduate of Purdue University, where I graduated with a degree in financial planning. So I am one of the rare instances of somebody that graduated and is using their degree. It's less and less these days. So I'm proud to tout that as we go along. But so Megan has invited us here as SOFA to kind of share some of these different financial education topics. And this was part 2 of a 2-part series that we discussed. And if you weren't able to make it a couple of weeks ago to our financial intelligence program, that's okay. Today's program piggybacks along with it, but it also stands alone on its own. So you'll be able to understand it. But if you wanted any more information on the previous presentation, reach out to Megan. She has a copy of the slides, or you can reach out to me directly as well, and we'll be sure to get those over to you. But our topic here this evening is to kind of talk about what happens when the market gets volatile. Okay, so how do we go about approaching market volatility when it comes to our investment and our financial planning? Okay, so in our last series, we talked about all the different investments that are available, which are more secure, talking like fixed income, certificates of deposit, fixed annuities, which are more volatile, are equities, ETFs, mutual funds, things of that nature. So once we talk about the different types of investments, now we kind of have to address what the market activity or the market outcome is going to do to your financial perspective. So part of what I stress a lot is have a plan in place, okay? This doesn't matter how old you are, how close you are to retirement, anything. It really would behoove you to have some sort of financial plan in place, retirement plan in place, because otherwise, what are you investing for and how are you investing? So we'll talk about some common scenarios that we're all going to experience. We know the market doesn't always go up. The market goes up and it goes down. And it hurts a lot more when it goes down. And we get very euphoric when it starts to go up. When it seems like anything that we do is working out in our favor, that feels great. But we know that the market is volatile. And this is kind of timely because the month of April was a pretty volatile month after having about a good 6-month run in the market. We had a very volatile April where we lost some ground that we made up, but May has started off well again. So, one of the things that I stressed in the previous presentation was try not to market time, okay? It's almost impossible to market time. If anybody tells you they know the right time to get in the market or out of the market, why would they be sharing that with you? Why wouldn't they be living on the beach in their gold house, where they could just make their billions of dollars? So one of the one of the points that I stressed last time was it's time in the market, not timing of the market. So that's kind of what we're going to talk about today. So some of the repetitive investor scenarios that we see when the market's down, your share prices drop, but your number of shares has not dropped, meaning, excuse me, meaning that as long as we stay invested, as long as we stay in our positions, that as soon as those positions start to recover, we are going to partake in all of that recovery. Now, on top of that, if we are still in the process of currently investing, whether it be in our 401k, 403bs, IRAs, Roth IRAs, and we're doing it on a consistent basis, when the market goes down, we're actually able to buy more shares for the dollar amount that we want, so that when that position, when the market does recover, our overall account balance is going to grow at a much greater pace. So it's important to not panic when we see markets go down. So in order to declare a loss or a gain, you must act, or you must decide to sell a position. Okay. Now there's many reasons why we would want to buy and sell and trade our accounts, but just because the overall market is down, just because our overall portfolio is down, isn't necessarily a signal to sell everything and go to cash. Okay. That's where I say we need to have a plan in place. If your plan is to retire at 60, 65, 70 years old, whatever your age is, you should have an investment plan that goes along with that, that builds in market volatility. So being sure that we're not just buying and selling because we get nervous, because we heard from a neighbor, cousin, some Joe Schmo on the street that, oh, the market's going to go down 30%, so I'm going to get out ahead of it. Because the chances are we're not going to get right back in at the right time. So stop trying to time the market. In fact, when the market is down, this is going to be counterintuitive, but when the market is down, it's typically a really good buying opportunity. If you guys remember back all the way to March 9th, 2009, nobody knew that was going to be the bottom of the market from the financial crisis. But those that were buying at this time were able to make money hand over fist because they knew the market's not going to go down forever. So I'm going to continue to dollar cost average. I'm going to continue to employ fund. And now is a good time. To try and hit that exact date is nearly impossible. Okay. But if we're consistent with our investing and our style, then we will share in those upsides. So again, I mentioned that there's opportunities to buy and sell, whether it be through reallocation, rebalancing, whatever the term that you want to use. But the only time we should be doing that is if we actually have a change in strategy for a reason other than market volatility. So again, we don't want to sell when the market is low and buy when the market is high. That's counterintuitive, right? We know it's buy low, sell high. That's how we want this to work. So being consistent with our investing, being consistent with our purchasing of funds as we go along. So kind of the rules that we need to understand as we partake in this investing is income is what we earn, okay? Whether it be our W-2 income, okay, our consulting 1099 income, but what about dividend income? What about interest income? What about coupons from our fixed income? Okay, bond income, things like that. Now, wealth is what we actually get to keep. All right. That's our nest egg. That's our net worth. All right. Taxes. I do a whole presentation on taxes. Taxes are an obligation that we are required to pay, but within reason. Okay. So this is where you have to do proper tax planning to make sure, hey, I'm okay paying my fair share, but I don't want to pay any more than I have to. I don't want to leave the IRS a tip. They don't want to give me back anything, okay? So why give them anything unnecessary? That's why tax planning is so important, okay? Debt. We're all of the mindset that debt is bad, okay? But there is good debt and bad debt. Credit card debt, really bad debt. Mortgage debt, good debt, okay? Debts to purchase automobiles, as long as it's within reason, within our budget. We're not taking out loans to buy Lamborghinis when we only have an income of $60,000 or $70,000 a year. All right. So let's be knowledgeable and understanding of the debts that we are taking on and making sure that we're using leverage properly. Now, in today's interest rate environment, debt has not become appealing. I get a lot of questions about whether or not I should pay off my mortgage before retirement or how quickly I should pay off my mortgage. Well, if you're one of those that was lucky enough to lock in a good mortgage rate before interest rates started to skyrocket over the last couple of years, I'm not in a big hurry to pay off the mortgage right now when I can get a good savings rate at 5%. So if your mortgage is at 2.5 or 3%, and you can earn a risk-free 5% in a CD or an annuity or something like that, why would I pay off my mortgage? Why not take advantage of these good savings rates? So something to keep in mind. So one of the biggest obstacles that I encounter with clients and people that I work with is behavior. It never feels good to see the market go down. It never feels good to see account values go down, whether that be because of market performance or because you're drawing income. So again, having a proper financial plan in place is going to help you sustain some of these bad behaviors that we might encounter. So stop trying to time the market when we're going to get in, when we're going to get out, and just stick to your overall plan. So what do we want to do? Obviously, we want to try and increase our wealth, accumulate as much wealth as we can while we're earning a paycheck. Again, that's where our accounts, our 401ks, 403bs, IRAs, Roth IRAs come into play. I want to make sure that I'm doing proper tax planning, proper tax diversification while I'm in this accumulation phase as well. Not everything should go to pre-tax accounts. Maybe I should be looking at after-tax accounts. Maybe I should be looking at tax-free accounts. So working with your advisor on how to properly distinguish how much should go in each bucket. Use diversification, okay? We know we don't want to put all our eggs in one basket. So diversify between equities, bonds, fixed income, okay? Diversify between asset classes or sectors, okay? Anything that we can try to do to alleviate our overall risk in the portfolio. Again, we want to build a plan with a solid strategy, okay? Build your plan and then execute your plan. Now, I mentioned this in the previous workshop a couple of weeks ago, that planning is fluid. It's going to change for us all the time, all right? There's going to be things in life that occur, that happen, that are going to make us have to make adjustments. Whether there's a death in our family, whether we receive an inheritance, maybe a child moves home, things like that that are going to help make us adjust our plan. So the plan that you put forth today is not going to be the plan that you finish with, but having a plan to start with so you have a track to run on is so important, okay? And then obviously we need enough money so we can live our life the way that we want to live our life, all right? Like I said, I'm a retirement planner. I don't want to see people living a lifestyle in retirement that's less than what they were doing while they were working. Retirement is your time to thrive. It's your time to get out there and do all the things that you wanted to do for the last 30 or 40 years that you were working. So this is why we need to make sure we accumulate enough funds to be able to live this lifestyle that we're accustomed to. So again, timeframes. Last time we talked about different buckets that we could use. So we have our short-term investments that are going to be used for our everyday cash flows, our short terms, 1 to 3 years, okay? Then we have our midterms. That's going to be 3 to 7 years where we might take on a little bit more risk. Then we have our longer term goals that we're going to use, and that's where we'll have a lot of our equity concentration, our more volatile positions, okay? Again, being aware of the tax consequences for our investments and the accounts that they're in. Anything that's in a pre-tax account. So again, our 401ks, IRAs, we know that gets taxed as ordinary income. Anything in our after-tax brokerage accounts, we know that typically gets taxed at capital gains rates. And then anything that goes into our Roth accounts, Roth 401ks, Roth IRAs, we know that it gets taxed on the way in, but never gets taxed again, okay? So being aware of the different tax circumstances that we have. Diversification, again, we talked about diversification, but diversification isn't just between stocks and bonds. It's between different asset classes. But again, to take it one step further, there's tax diversification as well. Pre-tax accounts, post-tax accounts, and tax-free accounts. So there's lots of different levels of diversification. It's not just 60-40 stocks and bonds. No, we can diversify even further to help spread out some of that risk limitation that we have. Okay. Liquidity, again, we're talking about those short-term buckets. We want to make sure we have enough liquid assets so that, you know, if the market goes down by 10 or 20% in those early years, we can weather that storm because we have liquid assets available to us, whether that be in our checking and savings accounts, certificates of deposit, money market, fixed annuities, low risk investments like that. Okay. Long-term perspective. When I'm planning for retirements, I'm planning for 20 and 30-year retirements. Now that sounds like a long time, but people, we are all living a lot longer. Okay. We are all outliving the generation previous to us. So have this long-term perspective. Just because you're retiring doesn't mean that you switch all of your investments to fixed income. Okay. If I still have to plan for you to be living for another 20 or 30 years, the chances of you outspending that money is going to be even greater if you go straight to fixed income. So finding the right balance that fits your risk tolerance. Okay. Don't get overly sentimental. A lot of you will have company stock in your 401ks. Okay. You might be very loyal to the company that you've worked for 20 or 30 years, but that stock's not necessarily going to be loyal to you. So don't become overly sentimental on certain positions, whether it be company stock or a stock that you bought when you were first investing, okay? Because things change. It's time to diversify a little bit more. It's time to spread out our risk, okay? And then again, having a specific investment plan. Have your plan, stick to your plan. Don't listen to what everybody else is doing. You guys can watch plenty of cable news channels that'll give you different financial advice for you to navigate through, and it's all going to be different. So working with your advisor to make sure that you have the proper plan in place. Before I jump forward, are there any questions in the chat that we need to be aware of? No?
No, right now. Questions, anybody?
I'll save it to the end.
I'm sorry, repeat that?
I will save those questions to the end, towards the end of the presentation.
Okay.
Thank you.
So what are some of the key investments to building your investment cake, to putting the proper recipe together? Okay. Market declines are going to happen. We know that's going to happen. In fact, on average, each year we will see an intra-year decline of at least 10%. That happens the majority of the time. Okay. We know to weather those storms. Okay. Something that I feel, especially, excuse me, this past month of April, some of these corrections are actually good for the market. It kind of shakes out some of the brush. It shakes out some of the bad things that were in the market. It gives the market a chance to breathe, because the market is a living and breathing thing. So by having the correction that we had, gives people an opportunity again to buy at lower valuations when they're buying their stocks, their bonds, their mutual funds, or ETFs. So something to keep in mind, that when we do see these corrections happening, almost thinking, hey, this is a good buying opportunity. If I have some extra funds, if I have some money that I was looking to invest, now is a good time. Again, this is kind of where we were talking about average drawdowns throughout the year. Okay, we see it all the time. Okay, the market could end up positive for the year, but have a 10% drawdown throughout the year. So something to keep in mind when it comes to our behavior, and not panic selling, not getting built up in the hype and the hysteria, but really sticking to our plan and staying the course. So a couple of other things. Market timing doesn't work. All right. It's nearly impossible to do. So in an ideal world, we would all be able to time the market. But again, this is where consistency comes into play. If you've ever heard of the term dollar cost averaging, that's being consistent in your investing, purchasing in increments over a stated period of time, whether that be weekly, monthly, quarterly, whatever fits your purpose. Okay. That is dollar cost averaging. Quit trying to time the market. Are there going to be opportunities when we see large drawdown to maybe get a little bit more aggressive in investing and buying opportunities? Sure. Okay. But again, trying to trade our portfolio to switch to cash, to avoid market losses and things like that, it's not going to work. So staying invested and sticking to your plan is historically served you much better than trying to time the market. Okay. Many of us do find it difficult to invest when the market is down. Again, behaviorally, mentally, it doesn't feel good. This is when your market performance has to be counterintuitive to what your heart and your gut feels like. If you feel like, oh, I'm losing a lot of money right now, that's probably the time to start to jump in. I'm not telling you to double down. I'm not telling you to put more money in the market than you could afford to lose. But I am telling you, consider some of the buying opportunities that you would have, okay? So again, having this plan in place. What is your plan? Are you going to continue to dollar cost average and invest at the same rate? Are you going to, maybe you got to raise at work and you're going to consider investing more? Something to keep in mind. So invest regularly, invest consistently. So this is kind of a scenario where dollar cost averaging comes into play. All right. Just being consistent with your investing and shows the amount of shares, that the difference in shares prices and the different in shares, number of shares purchased. Okay. Showing you what the average cost of shares are, things like that. So it's not a perfect science. But if you are consistent, that is the greatest and easiest way to build wealth over time. Measuring true performance in a bear or bull market can be done in different ways, okay? You know, beta is the volatility, the risks that we're taking of a portfolio. And this is industry jargon, I'm aware of that, but it's something that we hear a lot of. Beta, standard deviation is a measure of a portfolio's risk. So the lower the standard deviation, the less volatile a portfolio should be, okay? So again, nobody should be taking on more risk than they're comfortable accepting, okay? Not everybody should be invested 100% in equities. Not everybody should be invested in 100% fixed income, but finding that good mix for you that will help you to determine what you're comfortable with and help you to achieve your goals, okay? There are a couple different investment strategies. There's passive and active, and there's more than just these two, but these are the two most common. Passive meaning you have a set portfolio. You're going to continue to invest in that portfolio in order and be very consistent with that, only changing up the portfolio for rebalancing at a consistency that you're comfortable with, versus active investing is where you might try to seek out an undervalued asset class, an undervalued position to try and generate more alpha or more gain in the portfolio. Okay, so using technical or fundamental analysis, whichever, again, you're comfortable with. So as a whole, the industry has started to gravitate more towards passive investing, okay? But there is opportunities in active investing. But again, this is not market timing. This isn't trying to beat the market as a whole. It's just sticking to a strategy, having a well thought out strategy on how to generate more alpha for your portfolio. Okay. Technical analysis versus fundamental analysis, okay? Technical, we're looking at things that like supply and demand, timing of earnings, looking at different market trends, okay? This is where we're doing a lot of chart analysis, things like that. Fundamental analysis is where we're looking at the company as a whole. What is its profitability? What is its productivity, its earnings, things like that, okay? So that's the difference between technical and fundamental. When the stock market is in a decline, what should you do? Okay, you should evaluate specifically how each investment has performed. Okay, I'm not telling you turn a blind eye to your portfolio, ignore it, lock it in a drawer. No, you should be constantly monitoring it, making sure that the positions that you hold are still meeting your needs, still meeting what your goals are. Okay. You could sell some of your losers. Again, by telling you to stay the course and be consistent, that doesn't mean sticking with all your losers all the time until the day you die, okay? We're not setting up a permanent portfolio for the rest of your life. So finding opportunities to sell off some of the losers if they're no longer serving a purpose in your portfolio. This could also generate some tax benefits for you over the long run as well. So doing some tax loss harvesting where we're selling off some of our losers to offset the gains of our winners. That's something that we look at often when we're in market declines as well. Okay. Continue to rebalance your portfolio at your set upon schedule. Okay. In my firm, I do a biannually rebalance. So twice a year we'll rebalance. Every June and every January is when we rebalance. So something to keep in mind. Okay. And then don't turn a blind eye to what's going on with the market. Try to understand exactly why the market is behaving the way that it is. Okay. Is it something geopolitical, something completely out of our hands, such as what's going on in Israel right now? Okay. Is it something economic? Is it due to interest rates rising? Okay. Are we seeing another housing bubble? Things like that. So do try to understand why the markets are behaving the way that they are. If it's not something that you want to do or enjoy doing, then you should be enlisting the help of a professional to help you with that too, where it's their job to follow up on the economic conditions and the market performance and trying to enhance your portfolio overall. Okay. Some things that you should not do, obviously, don't panic. Okay. Just because the market has gone down 10 or 20%, doesn't mean that you should panic and go to cash. Again, your plan should dictate exactly how you approach your market investing. Your plan should be able to weather the storm of a market decline, a substantial market decline for a year or two. Something that we do at our firm is we hold 1 to 2 years of expenses at least in risk-free investments so that if the market goes down, I don't have to sell out of positions to generate cash for you to live off of in retirement. We have enough cash on hand to weather the storm. So something to keep in mind. All right. Again, don't sell all of your investments. Don't go to cash. We don't want to miss the opportunity of getting back in the market. Okay. Don't jump into the stock market with all your available cash. Again, be consistent. We don't want to put all of our eggs in one basket. Yes, there are great buying opportunities, but again, when I say I'm putting 1 to 2 years worth of cash, just because the market dropped by 20% doesn't mean I should take that cash and put it in the market to try and eke out extra returns on that. It's earmarked for a reason. It's earmarked for us to live off of, not to make money off of in the market. So again, don't listen to all the Wall Street pundits. I feel like we keep talking about this, the Jim Cramers of the world, they're entertainers, the MSNBCs, the CNBCs, all these different places that we can find market media all over the place, that'll push and pull you in all sorts of different directions. So stick to your plan and because those pundits don't know anything about what your individual plan is. So with that being said, I will open the floor to questions now for anybody that has any.
Thank you. This was a great presentation, and from my end, I'm new to stock market. I'm trying to capture all the information and see when is the right time to enter. Am I too late, or is that something that I understand you did cover this in the first part of your presentation. It's never late, but what I'm seeing around is with the news going on, everyone says there is a correction expected post-elections. Is that true? Do you suggest me to wait till then?
Megan, can we turn the camera onto my crystal ball so I can predict exactly what's going to happen? No, we can't predict what's going to happen.
Agreed.
Because of the election or anything like this. But something I can share with you, I was at a conference a couple of weeks ago with some very high-level economists, and obviously elections top of mind to everybody. But what we've learned over history, so over the last 16 election cycles, only 4 of those election cycles have produced a negative market. Okay, so 25%, which is still a fairly large number, but 75% of the time, the market is positive during an election year. And it doesn't matter if it's Democrat, Republican, incumbent, or challenger. That doesn't matter at all. So the overwhelming majority is the market will be positive for the year. Now, I can't predict that for sure, and I can't say by how much. I would say that we just experienced our intra-year correction in the month of April. That was a great buying opportunity for the year. So that was something to keep in mind.
Got it. That makes sense. Okay. And is there I mean, for a starter, is there a ratio that you normally suggest for equity versus bonds versus like where you put your money in? I mean, I understand it depends upon the individual research, but from your suggestion perspective, is there a number that you suggest normally?
Yeah, there's not a blanket number that I use for everybody. It's all based on your individual risk tolerance. So I have an 80-year-old client that has more than enough money that they get from their pension. So they're very aggressive in their investing in the stock market because they don't need any of that money to live off of. Versus I could have a 55-year-old that is very risk averse and doesn't want to have any money in the market. So there is no blanket statement. It's all based on your risk tolerance and the risk exposure you're willing to accept.
Got it. And from a source perspective, like, I mean, these days, you never know who should you follow or whom should you believe, because end of the day, of course, it's your risk that you're taking, but are there any reliable sources that you suggest to follow or watch on before making a decision?
As far as individual, you have to find somebody that aligns with your belief. Okay.
Okay.
So, I follow a lot of the guys at Ritholtz Wealth Management. My beliefs, my philosophy tends to align with them, but they might not align with your investment philosophies or your investment beliefs. I follow a lot of the people with Dimensional Fund Advisors, DFA, because they're based out of scientific research when they build their portfolio. So those are just some of the things that I follow, but again, it all has to be aligned with what your philosophy is.
Got it. Agree. I'll do some research there. Thank you. And my last question, do you have any suggestions for crypto?
No.
Got it. I mean, see, people are talking about them, but I mean, I don't know where we are going to end up with. I mean, considering the Bitcoin, the craze that's going around with it.
My only suggestion is do your research. Don't turn a blind eye to it, but do your research to determine whether you feel it's going to be something that you should pay attention to more.
Got it. Thank you. That is all from my end. And thanks so much for all the details.
My pleasure.
Can we talk very briefly? I know in the last presentation, you gave a resource for people to check out financial advisors.
Sure.
Can we share that one more time?
Yeah, if you want to, it's called Broker Check, and it's through FINRA, which is a government website that monitors financial advisors, not Social Security, financial advisors. So if you just Google Broker Check, it'll come up, and it's an ability for you to type in your financial advisor, somebody that you're meeting with, somebody that you're thinking about meeting with, to see what is their history. How long have they been in the business? What firms have they been with? What licenses do they hold? What states are they registered in? And then most importantly, what type of disciplinary history have they had over their career? So it's a free resource for you to use to check anybody out.
Awesome. Thank you.
Yeah. All right. I threw Broker Check's website up on the screen for people to view there, so people can see what it looks like.
Yeah.
Yep. Got it.
All right. All righty. Well, thank you everybody for attending this evening. Like Megan said, if anybody has any questions, if you want to shoot me over an email or if you want to give me a call, I'm happy to help any way that I can. Use me as a resource when it comes to, your planning needs, anything I can do to help.
Absolutely. Thank you so much for your time and all the details.
Thank you.